We see the goods staying up there, but it is a two-sided thing. So the amount of goods actually are starting to fall, but we have seen inflation, and that means that the total value of goods being bought remains relatively stable. And I think that's also how this picture in the US continues to look well. And even internationally, actually, you're seeing a lot of companies reporting very, very strong sales line. And that's obviously how many goods you sell, but also to what price. And then price has moved up and is continuing to move up. So if you have a slowdown in a higher inflationary world, which we are not used to in the past, then often that slowdown can be masked by these price increases. So maybe your total amount of goods sold are going down, but as the price increases, your total sales lines continues to look quite well. And I think that's what's going on at the moment.
So help us understand how you're negotiating equity markets at the moment, given that I think everybody is anticipating a slowdown in earnings growth for the rest of the year, but the markets still continue to have these recovery days.
Yes, and I mean, if one looks in the past, these markets, these corrections can obviously go in different ways. They can be sharp, like we had during COVID because something happened, or they can be slow. Like it was, for example, between 2000 and 2003 as well, where it stretched over multi-years and had big rallies in between. So there are various scenarios, and if one know in advance in what scenario one would be in, one would make a lot of money. But it doesn't have to be, always down. So I think this will continue the way we've seen the market here. That have found sort of a bottom in the summer and some upturns and some, testing of the lows. Because, as you said, there are a couple of things that are not looking so great. Interest rates are going up, commodity prices are high, we have high inflation. These are all areas that are obviously depressing the valuation of equities. But underneath, the equities continue to produce quite strong numbers. So at one stage, something will give, and that's what the market is really focused on, and that's what one should be focused on as an investor, to see what's the next move. Is there any systematic risk coming up from anywhere, or are the earnings really deteriorating? Or are we having, for that matter, a soft landing and maybe some of the conflicts and political things also brighten up, and that would give equities a boost?
Max, I'm surprised my colleague hasn't gone straight to the data you've supplied us on freight costs beginning to come down. We understandably, I think, have a mild obsession around this desk about forward freight rates as well and what it means for the world. But what do you think the ramifications are of these costs, which, according to your data, look like they've actually fallen quite dramatically?
Yes, they have, and I think that goods inflation, the peak is in. It's everywhere. It's rolling over. May it be container costs, maybe second-hand cars. All these areas one sees the peak is in, and it's rolling over, and it tries to come back to a normalization. And I think that would be the right thing in the medium term. I mean, the whole issue came about with COVID, and then a huge amount of stimulus. In hindsight, probably a bit too much stimulus. That caused this spike of 18.5% we were talking about of goods. And put this in historical context, I mean, an 8-9% fall in goods was enormous. You needed a great financial crisis. You needed a really sharp recession to get that. So a rise of 18.5 is historically unprecedented. So no supply chain in this world could have delivered those goods. That's why we have seen what we all have seen. Now, that is now over as the people can switch back from spending on goods, also spending on services, as well as the stimulus is obviously not a continuous measure, and it's been going away. So we see goods normalizing, but of course, that's the thing the Fed you were just talking about facing is services now are in the focus of the consumer spending, going on a holiday, getting out more, all that is happened already for the best of this year. So that is coming up, giving service pressure, inflation, wage inflation. And for the US, unlike for others, they have rent in there too, which again is coming up after a fulminant rise in US house prices. So this is the three components. You have wages coming still up, rent still coming up, but definitely goods are coming down, and that will the Fed has to navigate.